The S&P has rallied strong this week. Is the downturn over or is this a bull trap? We go over the markets up to June 6, 2019. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on the examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against loss. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, we examine the weekly chart action of the S&P 500. We look at the Russell 2000, how is it doing? We examine the New York Stock Exchange advanced decline line, the new high-low line, and the bullish index. And finally, what does this mean? Our first chart is of the weekly chart of the S&P 500. The S&P started the week below its 40-week moving average. It has had a nice bounce off the important long-term moving average. But not all is great. The S&P is still below its 10-week moving average. It will need to get above that important line before a true rally can begin. As we see in October 2018, price recovered after initial downturn, but even after a 7% gain, could not close above its 10-week line. Eventually, the downward pressure was too much and price just dropped in December. With so much downward pressure over the last month, we see the MACD is still negative. Now, will this week be the beginning of turning that back to green? This will be very important that the MACD does not remain negative for too long. In this slide, we see the Russell 2000 Small Cap Index. We will use the same weekly charts. Now, just quickly glancing, we can observe that unlike the S&P, this index failed to come close to its old high. Also, we see a very weak moving average positive crossover in April. Now, both its moving averages are sloping down with price below it. This is troubling. Even though we don't need all indices moving exactly in lockstep, it would be good for the overall U.S. stock market if the trend was healthier than what it currently is. Now its MACD is in lockstep with that of the S&P. After stalling in strength, it went negative several weeks ago. The quicker this can turn green, the better chances this index may have in turning around a weak trend. The first breadth indicator we look at is the NYSE advanced decline line. Technical traders look at this line as it shows us if stocks are advancing or declining. Looking at its weekly chart, we see that this indicator was under pressure since mid-April. But unlike the S&P, this index did not fall below its 40-week line. In fact, as of June 6, it has recovered back above its 10-week line. So despite having concerns of price action in the S&P, this breadth indicator has held out. One area to keep an eye on in this chart is the weekly MACD momentum indicator. For now, we see a small negative orange bar. Now, it may just be from the cumulative result of the downward pressure over the last month. The key will this be short-lived or a warning sign? Too soon to tell, so this will be an important indicator to keep an eye on over the next several weeks. The next market breadth indicator I would like to examine is the new high-low line. Traders consider this a leading indicator for technical analysts. It shows us the number of stocks making new 52-week highs. Now here we see that this index is still below its 40-week line. And after seeing the struggles of the Russell 2000, we can understand why. Not all stocks have participated in the stage 1 rally attempt. But there are two bits of positive news this week. One, we can see the red portion of this line turn back green. Looks like we may have hit an intermediate term low. Another positive is even though this index is below its 40-week line, it did hold above its rising 10-week line. And now it looks like it is about to challenge that long-term 40-week line. Another positive is this MACD is still in green. So even though we see a slight weakening in the bars, it has held in positive momentum. Let's see if momentum can hold positive and see if it will be enough for the index to break above its 40-week line. Our final breadth indicator is the NYSE Bullish Percentage Index. The Bullish Percentage Index is a breadth indicator based on the number of stocks on point and figure buy signals within an index. So anything above the 50 line would be considered bullish. Looking over the past week, we do see an intermediate term low. But despite the rally this week, the indicator is still below its 50 line. That is still considered bearish. The key will be to see if this rally can get this indicator above its 50 line. Its MACD still shows negative bars. Unlike the S&P, which shows two negative bars, this index was weaker 1 week before. Like the S&P and the NYAD line, for us to be truly out of this downturn, this indicator will need to get back to green soon. What does this mean? This week we saw the S&P and the US stock markets rally. Now, that does not mean we are out of the woods just yet. In the case of the S&P, it will need to get back above its 10-week moving average. We did have positive signs as it did bounce back above its 40-week line, but now will need to get and stay above its quicker moving average. Despite having price concerns over the last several weeks, the one index that has held strong was the New York Advanced Decline line. While many indices fell below their 40-week moving averages, this indicator was able to hold above its long-term moving average. So the overall view as of close of business on the 6th of June is caution. We are not in the clear just yet. There are still some concerns that some indices and indicators need to get above their key moving averages and key lines. Also, momentum for most of these indices are negative. That will need to change to green. But there are some positive signs as of now, as the S&P got above its 40-week line, the New York AD line got above its 10-week moving average, and we see a new charge by the new HighLow index to get above its 40-week moving average. As I mentioned over the previous video, the key will be the next several weeks. 1 week has passed and we saw positive short-term movement, but some key hurdles need to be passed. Stage 1 rally attempts can be volatile and bumpy. We are going through that right now. The key will be, can it hold its stage 1 status, or will this short-term rally be a bull trap? Caution is the key. Let's keep a close eye over the next several weeks. Thank you for viewing my video. Please like and subscribe to my channel for future videos. Also follow me on Twitter at my handle HRSNYC.